This is Justin Pulitzer. This is my weekend review video for Sunday, March 27th, 2016. Happy Easter. A decent amount to cover, but believe it or not, most of the upcoming week's price action I think is really going to have to do more with the overall averages as opposed to individual stocks. So I'm going to try and focus on that a little bit more in this video, but we will definitely, obviously, cover stocks. So I want to start the video off by saying if you happen to be an early adopter, quote unquote, watching this video like almost instantly when I publish it, and the video quality isn't that good, just put it on hold and restart it a little bit later. For whatever reason, I have no control over it. It takes YouTube a while to process the higher resolution versions. I actually shoot these videos in 5K. YouTube can't handle 5K, but they can handle 4K, so if you give it a little time and you reload, I assure you, you'll have a really super crisp version of this video. Anyway, let's jump in. I usually like to start these videos off by covering the 6 market keys and now the 7 Fed keys. So I'm going to do that. So let's start off with the VIX. A few weeks ago, I created a VIX chart. If you want to pause it and go through that, that kind of gives you my view of where I think ranges and key important ranges and inflection points, some of which that I've marked off on the chart here, take place. And I'll say with regard to the VIX, what was starting to be a little bit concerning was we had moved from a period of relatively benign volatility with, some, I wouldn't even call this panic, but sort of like volatility light. And then we've gone from a period of lower highs here to starting to make a period here with higher highs and higher lows. And I had said in the last weekend video that the snap of the trend to me seemed like that thesis of the switching of volatility, sort of the pattern changing from, benign volatility to more extreme volatility. That thesis was sort of breaking down here. I said that I thought we got a little bit extreme here and that I expected a throwback to the trend line, and then we'd see, and it would probably be, here we had the failure. We had the throwback to the trend, and it wound up being a pretty epic day. Basically, it opened on the highs and closed on the lows. That's really not what you want to see. I will say this now with regard to volatility. If you can take out these highs here, these 1644, then I think things will start getting a little bit more dicey, at least with regard to the market and volatility going to the upside. We have a scenario here. I'm going to talk a little bit later about the potential here for the shake and bake setup, which is looking a little. It looks like that could be possible. But with regard to the VIX, things are kind of in the dumps here. We are definitely well below the, bombed out stochastically. This thing is sold out for quite a bit. We have some reference lows down here. The VIX never really gets sustainably below 10 or 11, even 12 in some instances. So even as this comes down, it's not like you can press it for a move down to like single digits. It's just not going to happen. So what I would say is you probably want to be playing directionally, either long or short here. And, if you start getting a VIX down into these reference lows, a little bit more low, particularly if we, let's say, have a rally into quarter end, you might want to load up on some cheap bets, to play for shorts. The dollar. So the dollar has been what I've considered, look at this. This has been a tremendous headwind on corporate earnings, and we've just been kind of in this choppy consolidation range. The dollar had a bit of a breakdown. We have lower lows off lower highs. The pattern is still quite bearish. But I will say this, some of the Fed comments, I think, got the market a little bit, got the market's panties in a bunch, so to speak. I guess it's a little bit crass, but it definitely is fitting. There is some more room up to the regression line that I've drawn in. It's a little bit of an unofficial regression line. Oddly, my regression lines tend to work quite well. You can see the back of this one that I still have drawn in. Moves below it have been unsustainable, as are this one. Moves above it have been unsustainable. So I will continue to use it until it does not work anymore. That being said, there is some significant now. This is the volume distribution here, the 25-23. You can see it's fairly obvious where that drop off in volume happens. So I would say a target up here, if you're long in the dollar, would be a good spot to start, looking to lay into some shorts. maybe this 50 and 100-day moving average confluence, I would be interested in a row short there. Or if you're playing long, it's a little late in my view to chase, but if you're long, that to me would be a good target. If the dollar continues to rise, it is going to be a problem for the market, though. I can almost certainly assure you that. The bonds. The bonds. What can I say about the bonds? They are very strong. I mean, we are well above the 2009 crash peak. We are basically consolidating. We held one line of support. Basically, this 50-day moving averages, moves below it have not been sustainable. You have a 50 and a 20-day moving average confluence. So if you're long, I guess you can play against Friday. Long against Friday's low. If you start breaching that, there might be, a little bit more downside in there. But overall, I think that this is kind of where you need it to hold. If you could take out that high, I would think that I don't want to say sky's the limit, to quote my favorite rapper, but you could have a quite significant push up. I had mentioned the market and getting a little bit, some comeuppance this week. I think some of the issues basically were around the Fed and some of the comments that were made by, I don't want to say loose cannon Fed governors, but I will say loose-lipped Fed governors. And we all know loose lips sink ships or cause stock market corrections. This happened early in the week by Dennis Lockhart. It wasn't taken very seriously until Bullard and a couple of these other guys came out and basically reiterated, saying that, all of the meetings are live, and they were starting to walk back Yellen's dovishness and starting to make it sound a little bit more hawkish. Now, overall, the April meeting, no one really thinks they're going in April, even though they want to say it's still in play. This had been like in single digits. And yeah, I guess it doubled, but that to me wasn't what caused the market sell-off. What did cause the market sell-off was the June getting a little bit of an upping in its sperm count, so to speak, and July. This is really, to me, what this was the problem. This is why the market had its little bit of a hissy fit this week with that gap down on Friday. The sell-off on Thursday and then the gap down on Friday, because after Janet Yellen had spoken, no meeting, April, June, July, had anywhere above a 50% probability. It was all low. Now you're up to July at a 55% chance of a hike to 0.75 of a point, and that is that's a bit of a problem. So before that, just so you know, September had been the month that they were all kind of betting would have the hike, and now it's pushed back. Like they had rolled it out further because the Fed had said that they weren't going to have 4 hikes this year, which the market already had whiffed out. They said that they would be considering entertaining 2, and that made it sound as if it was going to happen in September, December. Now it is being pulled into the summer, pulled back. They had pushed it out, and now it's kind of being pulled back. And that to me is the scare here. I think that the probability of a hike is now has now increased quite dramatically here to 55%. So that, I believe, is the reason why you've had a pullback in the market, although you wouldn't know it from the TLT. This is basically when the probability here was supposed to be going. The probability of a hike went up, and you'd think what that would mean higher rates, and that would mean lower bond prices. But what did bonds do? Bonds rallied. So I think that starting to get the market nervous again. Rate hike is starting to equate to recession. I'll tell you, I don't like to jump into the Fed keys, although I will often commingle them when I need to. And TLT is always a great spot to do that, because TLT and the dollar, because that's really what the Fed is looking at, that along with HYG, which they have basically openly admitted. So we had a GDP rating, a read on Friday. The market was closed, but those numbers, I'll tell you, if you're bullish, you'll be optimistic by them, but if you're realistic to bearish, you'll probably be a little bit less sanguine about the the numbers from the GDP. So we finally got our final fourth quarter revision, and the number was expected to be at 1%, and it wound up being 1.4%. So that's a pretty big beat, I guess nominally, but in the big picture, it's still quite weak. You're still below 2% growth in a fourth quarter. So yeah, the estimates were worse, but the number wasn't that great. So I guess it's sort of like being kind of the tallest kid on the short bus in that instance. The corporate profits, however, were down 8.1% quarter over quarter, and that I believe was after, I don't have the number in front of me, but I think about a 4%-ish quarter over quarter decline in the last read. Also, it was a 3.6% decline in year over year of Q4 readings. So corporate profits have been suffering significantly. I believe a lot of that is from the strong dollar. Nike had mentioned that, although the dollar hasn't really been in beast mode. So I think Nike just meant the overall number is still relatively high, and I think that was lost on the genius in the press. You had an NFP number that was sort of, neither here nor there. I mean, I think it was maybe a little. I think I'm sorry, not an NFP. I believe an ADP number that's the jobs number that I think was kind of okay. It wasn't really anything that I would make much of. I've gone on record saying that I think that the jobs are starting to. The quality of the jobs are kind of crappy. A lot of companies are still offshoring. We know that with the corporate inversions. We also know that the big job gains have been in service industry jobs, waiter, waitresses, bartenders. I guess now we're coming into warmer weather, so we're going to start seeing that Carnival ride operator line item again. I'm sorry to laugh, but it's actually really sad what's really happened to the economy. And I've mentioned in past videos, my big theme for the next 5 to 10 years is going to be the move from man doing work to further automation. And I believe it's going to get into white collar jobs as well soon. But I mean, it's decimating the kind of the blue collar workers. Car plants are more and more automated. I mean, you'll eventually go in there and it'll be like a guy in the morning to turn the switch on, and in the end of the day, someone to shut it off. And I'm sure at some point they'll figure out a machine who can do that also. I mean, we have alarms programmed in smartphones, so why not for plants like that? I noticed, I gave the anecdotal story that I was in a Pizzeria Uno after a late night movie. There was nothing else open. I'm not a huge Chicago Uno fan, but you could basically place your order on the table with an iPad kind of wannabe that basically eliminated the waiter. So I think that we're going to see more of that, and I don't think we're ever going to return to a more normalized job situation. That's just really my opinion. I don't want to get too more into this. These I like to save for Periscope. If you guys are really interested in this, I can elaborate quite a bit more and get into some other issues that I see being offshoots of that. If you want to leave a comment or tweet me, please do. If you aren't that interested, we don't have to really discuss it any further. ISM numbers, the manufacturing, ISM is rather, been disappointing. The PMI, we had a manufacturing read this week. Really, again, not great shakes. Service has been weak as well. Durable goods orders have been, they were a miss. They, I heard some people kind of trying to paint those numbers that they were good, but they're really not. Boeing has basically cut a lot of their production down. The autos have been kind of holding up, but it seems like they're kind of moving toward that more peak auto situation. Housing had been a big bright spot, cooling off a smidgen, but I think that a lot of that has been because we had a warm winter and a lot of the demand was pulled forward. So I'm a little bit concerned of kind of the back half housing numbers, if that makes sense. I know that just from anecdotally, I've been looking to make some property investments, and I've been noticing, a little bit of more wiggle room with regard to price and properties kind of sitting maybe a little bit longer. So yeah, I think that the housing isn't bad, but again, these are highly subject, again, also with the autos, by the way, highly subject to interest rates. If interest rates go up, these numbers are going to get the smackdown. there was a little bit of an uptick, in washers, dryers, and toasters I had mentioned a few weeks ago. I just think people had spent 10 months hiding under their desks or beds with their budgets for these things, and finally, I guess they got tired of heating bread over the stove, and they bought some toasters. So, these numbers have, to me, just been cyclical, but overall, structurally, I think there's a lot of trouble in some of these, in some of these reads, particularly like in the in the jobs numbers. Anyway, let's get back into that. So that basically takes care of our Fed keys. The unofficial one, it's now basically official because they've mentioned market volatility, so I've now made it from the 6 Fed keys to the 7 Fed keys, but that's the S&P 500, and I kind of am lumping that in with the HYG because I think that that's sort of like the risk equivalent for, I don't want to say for cowards, but for people who are chasing yield. We'll get into that in a minute. Actually, we could get into that right now with regard to the HYG. HIG, right? So this has had quite a run off the lows. It basically got close to where the breakdown level really took place, pulling back some. There is a 100 MA and a volume distribution here. So I would say 80-ish is really, really key. This 81-ish to 80-ish, look the lows here. Yeah, 80, 36. You don't really want to see it get too far below there. If it does, it starts getting a bit iffy, and I would say if you want to play put ratios, like if you want to play for a down move and then maybe to get long, buy something up here and sell 2 times out down here. Very short dated, of course, near this gap fill in the 50 MA and also the end of this volume distribution. I think that would be an interesting play. But the Fed mentioned that they were concerned about the high yield spread of corporates over treasuries, and as this rallies, this kind of helps the Fed out. It makes it narrows that gap a little bit. There was a lot of fear in that because of the energy situation. I'm going to go off reservation a little bit here. I hadn't been planning on talking about the XLE, but I will. Because I just, it came to me that it would be important. You can see there's been a downtrend here, and you have a very prominent 200-day moving average up here. It hasn't really been touched in quite some time from the initial breakdown. What I have to say about this is we're making some higher lows and obviously higher highs. However, we are right up against trend resistance, overbought stochastically. I've been a little cautious. I had talked about taking some profits in some of those names and looking at kind of BTD a little bit lower. The back off here had been a little bit mild. It got a little bit steeper here, and then Friday, you had the gap, and it held. I would say this distribution here is really key, kind of in the this bar particularly. I look for these big emotion day bars. Anything up over 61.92 to me is more bullish. Anything below 59.67 to me gets a little bit more bearish. And I would think you would see a 50 MA or maybe even more test back lower. I think energy, in my view, has turned the corner. I'm going to make the case to you that the pullback in energy here was really not all that it was cracked up to be. I would be, like I said, a right or right out buyer on trend here. Particularly if it had a 50-day moving average confluence, that to me would be a higher probability setup. A lot of people think trading is about, being right and guessing to be right, and yes, that's important. But for me, it's always making a higher probability trade. It's not really rolling the dice and guessing. Like if I have a trend line and a 50 MA confluence along with a volume distribution, I have 3 points ahead of me, and maybe a reference low or something that could now support again. That to me just increases the odds of the trade being correct. It takes you a little bit away from being kind of a chimp throwing the darts at the board. So that's my view on XLE. Going into crude itself, I want to point something out. We are definitely overbought here stochastically. This has been a really epic run off the lows. We got very close to the 200 MA, which was resistance here. You got into a bit of a volume distribution here. Look where we were topping out, where we were getting close into. This was also an area where with past support, which really became resistance, broke down, and now that's kind of people getting their money back. I want to also show you one important thing. There was a gap here. This was on a contract roll, and that gap filled in because the gap is sort of artificial. It just means that this is the continuous. It means that the contract, when it rolled into the next month, it was a higher price, so that gave back. This was the same thing. So basically you filled that gap. Notice this, after you filled that gap and maybe like a little bit test lower, it resumed the move higher. And look where it held here, the 20-day moving average. This one stopped ahead of the 20-day moving average, right basically a few ticks below the gap fill. So oil to me is acting stronger than it did the last time it had this consolidation pullback. We also know that this is basically midway into this bar. So I would say the 20 MA here, believe it or not, is a row level. If it snaps, then, we could be talking about 50 MA test. So I'm cautiously optimistic on oil. I think that this is just eating back some of this, but I am a oil kind of buy the dip guy. I'm a BTD guy in oil. Not necessarily directly in the commodity, but in like the XLE names, I always go to the big boy, the bad boy, right, of the index. Listen, I'm trying to make it interesting. I'm trying to use some colorful language. Reference lows, high volume areas, a volume distribution. I have talked about this 83, believe it or not, even all the way up to 86 level. I don't just pull these numbers out of the where. They are very important levels. It's good that we're consolidating here. You had the move up here, the back off, and now you're basically pressed up right against it, consolidating. I'd say that that's more bullish than bearish. We are a little bit overbought. The stochastics are trying to bend back a bit. We are holding the 20 MA. I would like a 50 MA touch. I would be a 50 MA buyer. You could see it was resistance here, a little resistance here. We broke through. We kind of supported. It didn't even quite get there, but you have a lot of moving average confluences here. You have 100 MA, you have the 50, and the 200 just below. So like this 79, 80-ish level to me would be okay if you want to play put ratios for a move down there, like buy these and then sell 2 times out of the money. I like that as well. It's also, believe it or not, a good hedge against longs. Chevron, to me, this just became a risk-reward problem. Look where we came up to. We were getting close to this old reference high, the 100 breakdown, the kind of the brown number, the end of a volume distribution. So I think it just was pulling back a little bit. Same kind of setup here with Exxon. The CEO of this company to me is a major stud, coming out and basically saying he'll do what it takes, whatever it takes, basically, honey badger style, to keep that dividend going. And that's what investors in these companies really want to hear, the big funds. Look at Friday. It was basically an outside day. Gap down and met with buyers and still closed over the prior day's high. That to me is bullish price action. That's, if you're long a stock, that's what you want to see. That being said, I'd be a buyer near the trend where these moving average confluences are. That's just, I had been playing long for this for a while. As stocks rise, they become a little less attractive sometimes. And when they fall back, they become a little bit more. Only in instances when you're making higher lows and higher highs. If a stock is making lower highs and lower lows, it's not becoming more attractive to me. When a pattern shifts, and this one looks like it's shifting, it becomes attractive to me to buy dips. That's the definition of buy the dip. I get a lot of messages from people asking me, oh, when is the time to buy in a situation like this, when it's making lower highs and lower lows. You don't want to be involved in that, Yeah, you may have missed the bottom here, but guess what? If you got in over around in here, you had the safer bet. You had reference lows. Now you have a trend that you're kind of have a primary trend and now a secondary trend, and you kind of know where to play off of. I'm not a guesser. I've never really been a guesser. I've just always been into the higher probability, quote unquote, the more sure money. I had been long Freeport. I took some profits in this around, I think 11, I believe. It got 11.45. It did pull back a bit. 200-day. It was just the 200-day moving average to me. Anything above there, I was getting a little bit concerned about. It made a move over. I guess that was bullish, but I don't know. It just, to me, it had so many days, and I just was a little bit worried. It's pulling back a bit. 20 MA held. It is below the 200 though, which is a little bit, I don't want to say disconcerting. I would be interested in buying back somewhere near this 50 or 61.8. Really, the 61.8 to me would be great. Also, a trend touch 50-day moving average if this were to have a continued pullback. That to me would be important. Also, if we were to just consolidate and then take out this high again, I don't mind paying higher when I know that it's kind of quote-unquote safe. That said, we are a little overbought. I wouldn't mind it to have a little bit of a consolidation. I mean, the stock did move from $3.50 all the way up to 11, basically 11.5. That is an impressive run. China, gotta have your China. Those of you who are YouTube fans know what I'm talking about. Anyway, China. So we are a little bit overbought here stochastically. Basically, this had held the reference low with a little bit of a peekaboo, a look below, and fail, which went straight up. We're back into some resistance here. Excuse me. You can see this kind of volume distribution. We got basically up to the 100 MA, pulling back. I'll get interested again somewhere near the backside of this kind of old downtrend regression line. Any move down close to the 50 MA, it's also this consolidation really where the breakout took place. I would end this reference low. I'd be interested in either selling puts or being a bit of a buyer down there. The BABA, yeah, so we rallied back up, basically got to the volume distribution, had a pullback here. The pullback was bought, so I will say this with regard to the BABA. You're holding on to trend by your fingernails. I was gonna editorialize on that a little bit, but I'll leave it at that. You're above all the major moving averages. I would be an interested buyer on a pullback maybe. My real fear with this one is that you have all of this volume here, this distribution, a little bit of a distribution here, all of this distribution, and now as you're getting back into there, these people are going to be looking to get their money back. These people had all been playing long, seeing basically equal highs with higher lows, and then when that snapped, it got really, really ugly. So I think you just have a lot of people, you could see based on here, this is where the dead bodies are. They're looking to get their money back. We are making higher lows with higher highs, so technically, I guess you can kind of BTD. I would be more interested in getting close into the next distribution, somewhere between 69.23 is the 50 MA and 71-ish, right in there. I'd be interested in a row type of a play. Anyway, that covers that. Let's get into the markets. Let's start with SPY. Why not, right? So we have a couple of expirations happening this week that are important. We have a quarterly expiration, and we have the weekly expiration. If for the quarterly, the expected move, I believe that's 4 days. We have an expected move of about $2.50. Not much difference for the weekly at the moment. That's like just under $2.93. If that were to play out from the close from Friday on the weekly, that would take you up to 206.05 or down to 200.20. On the quarterly, it would be 205.62 or down to 200.62. Yeah, so let's discuss the levels that we're at and the significance of what's happening here. I have talked about this 204.12 here on several occasions. Look what happened on the close below here. You had that nasty Friday and the flash crash on Monday. When you lost it here, you had the gap down, although I will say this, they got below the hammers. They tried to rally the next day. It got back up to, look where? 201.90. The high of day here was 201.90 to the tick. You know, anyone who questions these levels I talk about, this is proof in point that they work. They really, really work. After you got up to there and failed, it was just not pretty. Very ugly. You formed a W here. You have a quadruple bottom. There's another low back in the day. One here, another one here. The W pattern resolved. We got up to the 61.8 and the downtrend line, it resisted a little bit. You had a little bit of sell-off. You had an ECB day. You had a break of that day, a 200 MA breach, hold roughly, and then the Fed, and now some consolidation. My concerns were as follows. Look where we are in terms of the volume distribution. We are also at a 78.6 Fibonacci retracement. I don't usually use the 78.6s all that often for shorts like this, but I did talk about that we had filled the gap, we overshot a little bit, and I said that this was an area between here and the 206.76. That was an important level, as you can see, that I have marked off. I assure you that that's an important one, between there and 207. That to me is a good write or write out, would have been a good a further write or write out short. But look what happened here. You closed below 204.12, and the next day you had a very, very nasty gap down. This actually overshot the 201.90 to the 201.74, but what did we have right there to our rescue? And we had a 200-day moving average and basically the 201.90 reference level. That got bought. That to me is significant in the fact that when we had this gap, the gap eclipsed the 201.90. Here, it did not. It held it and rallied. We still closed, this is a breakdown of basically 4 days, 3 days of consolidation after two big pushers. And we basically got, a little bit of, some pullback here. It's bearish that we didn't take out these 3 days to the upside. I'm not going to sugarcoat it and say it's not. This is a bearish day. However, the character of the sell-off was a little bit different than it was this time. This to me was more bearish because you had violated these lows and you violated this level. You went from one level through the next, basically almost to the range low. Here it respected, held to 200. You have a rising 20, which is not that far below there. The 50 is now fully bent higher. These are all relatively more bullish signs. I've talked about two scenarios going into the end of the quarter here, meaning this final week. One was that we continued the rally here, and then the last week there would be a lock-in and there would be a sell-off, that people would book in all the profits. Or scenario two, where we would have a bit of a down move, also fondly known by me as the shake and bake, a little homage to Ricky Bobby. Any Talladega Nights fan would know where that comes from. If you don't know where I get that from, that is where I get it from, the shake and bake. So we get this move down, the shakeout before we bake it to the upside. I don't necessarily know 100% that it's going to play out that way. It's possible we get more lock-in until the end of the week. Maybe they'll sell the bejesus out of the market. I will say this, though. There could be some nice window dressing. I believe that is a very likely scenario, given the fact of what I just showed you, that this severity of losing the 204.12, the bears didn't really pounce on it. They covered, and people stepped in and bought. I wouldn't be surprised, and I will say this, I think that the price action on Monday and Tuesday are going to be really, really key. If we have a really ugly day on Monday, that negates this bar here to the downside, it could be Katie barred the doors down to the 200 level, which is roughly where the expected move is. Although I think if we lose Friday's low, it's going to be possibly more severe than that, and even take us maybe down to the 197s. Companies will be defending. What happens after next week is kind of a page flip of whether we're going to have a summer rally or a summer sell-off. I'd love to hear some comments on that if you guys want to leave me some comments and tell me if you think we're going to have a rally or a sell-off. But this, to me, this Friday day is really, really key. Over the high a day, you probably get continued squeeze. If you lose the low of that day, particularly in like a gap fashion, it could get it could be not so pretty. Yeah. You know what? Before we go in, now let's just do it. IWM. Basically, a little bit of a look above the 100 MA. Failed. Still below the box here. Really a lot of relative weakness in these small caps, which is surprising given the dollar, I guess the relative dollar strength that favors these American, kind of companies. If there's a run somewhere between the 212.62 and the 200 MA, which coincides with the primary downtrend line. That to me, and a volume distribution. There could be a little push through there up to the 115s, but roughly the 113s, I want to start laying into some shorts. I believe all of this supply up here, all these people who are now wrong, are very anxious to get their money back. And I would be, wow, I had a bit of a Midwestern accent there, very interested in getting their money back. So a move up to here, to me, would be a good technical right or right out short. And I'm sure you'll have a ton of people buying at exactly the wrong time. The channel did violate, actually, I didn't really draw this channel as well. Let's redo that now. I like to be very accurate. Channel. Yep. And I'll play with those numbers again if they are not right. Where is it? Where's the redraw as a channel? Usually it gives you the... Oh, I did it as a channel. What am I doing? Am I just not seeing something here? Usually it gives you the option to redraw as a channel. Let me remove the drawing. Sorry, this is my bad. This should have been done more properly. Maybe because I did it as a channel, I didn't actually draw the channel. That was the problem. All right, so there we go. Now we have our channel in there. Beautiful. Let's extend that to the right. So we can see that we didn't respect the channel fully on the downside. So we could have some kind of overshoot above the channel, but I do believe into this area, somewhere into here, is going to be a good right or right out type of a short, at least for a pullback type of a scenario. If this were to come back anywhere to like the 50 MA and below this 103.54, it'll probably get a bounce, but it would tell me that the market is signaling a little bit more weakness. Now, there was a little bit of controversy in the Qs this week. I'll show you why. The cash index, the composite, didn't quite reach the 200-day moving average. But if you look at the, and my Fibonacci's on here, just completely ignore them. I don't really use the comp very often. I need to completely redo the my analysis on the comp. Same thing with the NQ. This isn't really important. The NQ got there. That's the NASDAQ futures. And the QQQ also got the 200 MA. Obviously, the comp trumps it all. That's always the most important, but we did get there. We also basically got the 61.8 Fibonacci retracement. Doesn't surprise me that there is some selling. Looky here. 50 MA, key support. 50 MA, bending back up. I wouldn't mind some very near-dated put ratios playing with the 50-day moving average. I will say this. The 105 level, and look at this bar's low of day, 103.32. High of day was 105.86. If you lose this bar's low of day, I don't believe the 50 MA will support. If it gets there quickly and they're equal, it's a right or right out long. And if it doesn't work, it is a right or right out short. So like if we pulled back quickly into that area, this to me would be, if you're short, a spot to cover. If you're looking to be long, right or right out long. If that long doesn't work, you don't play the hope and pray game. You flip and you do right or right out short for a further deterioration. That to me would be the way. That is how I'm going to trade it. Frankly, that's the way it's going to be done. If we can take out this consolidation move to the high, like we'll get the window dressing, maybe in your FANG names and get the gap fill. I'm a little agnostic as far as which one I think will happen. I will say this. We talk about the box, how I say we're weak in the IWM. We are not weak in the NASDAQ, as weak. The NASDAQ did basically have a double top, a slightly higher high. But look, we're really not that far off those highs. There's not that many people, dying unless you're in, Valiant and some of these garbage biotech. Anyway, above the 20 MA, basically having some 50, 100-day sellers, the 61.8, doesn't surprise me. If the pullback is relatively mild, sometimes it's from one Fibonacci level to the next. As long as 105s to me hold, I think we're, quote-unquote, okay. Below 105 to me gets a little bit more iffy. Look what's here. This day's body. I think this body is important of this candle. So I would, even if you want to be really aggressive, you could use that body as a point here for a right or right out long if you want to try it here, if you think the pullback is going to be more shallow, or a right or right out short, believe it or not, even below this body, if you don't want to really wait for this for the tail. That to me is as valid of a setup. I don't really want to get into a whole Traders 101 seminar, but that is, I know what people look for. I know what traders look for. I know what I look for. That body to me, it's not that wide. This range is wide. All right, we'll do a little quick sideshow here. This range is really wide, and traders are going to say, how do I minimize my risk? I don't want to wait, for these entire tails. It's too long. They'll move to the body. That's just my, go for the body, kind of like boxing. That's my analysis on that. Alrighty. Let's do some fins. Why not? Let's do some fins. JP Morgan. Because this has been kind of the fly in the ointment for the rally. You had the diamond bottom, right? The Jamie Dimon bottom. It has held. The rally, though, has been rather muted. It is kind of lackluster. 50 MA move has held. If you want to be long JP Morgan, it's against the 50-day. If you are, look where we broke down from, the 50 MA, now it is acting as support. If you lose it again, get the F out or play a row short. But until you get below it, I wouldn't want to be short. I don't necessarily want to be long, but I wouldn't want to be short. Bank America. This basically had a very large sideways lateral range, double bottoms. Once those were lost, it got kind of fugly. The bounce has been rather weak to the 38.2% fib. It has just been consolidating there. I would say if it had a little bit of a push up here, you probably want to start looking to lighten up somewhere between the 1454 and the 1538. And if it were to get up to the 1538 to 1556-ish level in here, I would be interested in a row on the short side. Morgan Stanley, a little bit of a disappointing setup here. An inverse head and shoulders that had a neckline break, which failed basically to the lower end of range here. You're below the 50. If you start losing these lows, you might want a GTFO. This isn't really, listen, these things are trading at like single-digit PEs, so they're really not that expensive, and they also are down huge from the highs. So, I fully understand some bottom fishing down here. I think if you can you may have to suffer some indignities for a while, but if you can kind of sit on these for a long enough period of time, I don't think it's going to kill you to own them. But, for this purposes of this video, this is all what's going to happen in the next couple of days or weeks, not what's going to happen in the next few months or years. I would be a little cautious here with these lows. If you start losing this hammer, particularly on Friday, I would be a little cautious because there's a distribution here. Could take you down $2 rather quickly. The Goldman. Head and shoulders top, breakdown. I've said longer term this pattern is bearish. Shorter term, I was looking for a retest of the neckline. So, I still am. That's how I am. I'm still looking for it. I think it'll happen. Sometimes you get this noise and this chop. If you were to lose these lows here, the 148s basically, then I would say there's more trouble ahead, and you probably get the trend touch down to 135s. However, we did wind up eking out a close over the 50-day moving average. If you want to play long over 53.04, if you want to play short below 150.13, I think you could probably layer in a little bit to that using Friday's range. Let's just get into those momentum names we all love, right? The Apples, the Fangs. Apple's a little overbought here in terms of the rally. It held roughly where it needed to, the 92s. I had said I thought we would get up to the channel high. I'm still pressed. If anyone can find it for me, what happened here. I think this was just a bad tick or a fat finger trade. I never saw Apple trading 110. I will say this, I am a little superstitious when I see these things. I tend to think the machines see them too, and they tend to try to retest. I would love a right or right out short against the 200-day moving average and a primary downtrend line and up against past support, which could now be resistance. However, Apple is basically trading decently. We have held on, we had the move up to the 103s, the pullbacks, which basically held the 100 level, and now a move over the 103s. Anything above the 103.12 to 103.74 to me is still bullish. Anything below there gets iffy. Maybe you get the gap fill, but roughly this is the area that I see as being important. If that can hold, Apple can, continue to rally. If it loses here, you'll see the 100 again and maybe the 50-day moving average, in my opinion. And I would be interested in, I don't know what the volatility would look like then, but playing some kind of put ratios with a 50-day moving average being a key component there. I talked about in the beginning of the year that I thought there was only one FANG to own, and that was the F in FANG, meaning Facebook. Holy cow, did that turn out to be the correct move. I talked about, listen, anyone who wants to go back and says, say, oh, you don't know what you're talking about, you don't know how to time this stock. I don't want to brag, but I don't know anyone better at timing Facebook than me. I know that sounds really arrogant and obnoxious, but if you go back to the video, I talked about 110.65 being an area to lighten up into, and then I talked about 116.07 being where you wanted to really sell into. Yes, it got a little bit higher, but if you were smart and you sold up there, you have saved yourself a lot of heartache and could have bought back here, which I did. I've discussed that in past videos. And, bought some dips. I will say this, as long as Facebook is above the 110.65, the path of least resistance is higher. Anything below there, it gets to me a little bit iffy because you're taking out these reference lows and you're back, you're looking maybe at a move back into the 106s at the very least. Or a 50 MA, 100 MA confluence test. That 50 MA in Facebook is a very important level. You can see here it's been support. Once you lost it here, it got fugly. Here we did lose it. It got a little fugly, but it was able to kind of recover rather quickly, but did spend some time struggling with it. And you can see here the 50 MA again became support. This to me was a tell, very bullish, that a pullback swing low didn't even make it to the 50 MA. And that's why when you saw this trend break, it was really still bullish. I've talked about in the past there's a progression line. It's the same as a regression, but it implies upward movement. In Facebook, anything above there becomes unsustainable, as you can see. And anything, we are getting close to it again. I do believe Facebook could make new all-time highs. Longer term, I am very bullish on the stock. I think it can go much, much higher. Shorter term, I get a little bit cautious when we get into reference areas. And as we rise, I would look to sell into that progression line. So BTD, 50 MA, STR, sell the rip, or short the rip into here. That is my analysis on Facebook. Sorry if I came off as less than humble pie on that one, but I have been bullish. I hated the IPO from 38 down to 20. It did get to 19, but I have been bullish on it basically in a straight line ever since. So, Amazon. This chart is really kind of sloppy. 580.57. key level. We are basically strong. I mean, the stock is acting well. I thought this seasonally, this isn't the best time of Facebook. I'm sorry, Amazon. I thought we were in for a slog potentially like this. We still may be, but we are definitely looking a little bit more sharp in the in Amazon. I will cautious the stochastics. This peak is well below this one. I would say 50 MA here. Again, I mean, wow, I'm usually not such a huge 50 MA guy. I'm not a 50 MA kind of guy, but I really am becoming one here with this stock too. Look what happened when you gap below the 50. It got real ugly. This should have been a sign that this rally was not sustainable. We couldn't even retest the 50. Massive move lower, lower highs, lower lows. Now we're kind of like looking like we're forming, I don't know, some kind of like half-baked inverse head and shoulders. 50 MA was resistance here. Moves above it became unsustainable. Moves below it now became unsustainable. 50 MA and 200 MA confluence. So if you can take out this range high, this 585, and we closed just below there, you probably will see a push up higher, maybe at least to fill this gap. So I'm starting to get a little bit more cautiously optimistic on Amazon. You probably don't have as good trade location considering it's rallied for 3 days. And if you were fortunate enough to buy here, you probably want to book a little bit of profits here and let the rest run for a range break. If this doesn't and it fails, you'll probably at the very least see the 50 and 200 day moving averages. I would like that for a kind of right or right out type of a trade. Either to play for that short, for a move to a pullback back to there, or long right off of that confluence, depending on which direction you are and where you want to play it. The Netflix. All right, so this has been acting really, really choppy. I've been looking for a move back to 70 for a while. It's been stubborn. We haven't gotten there. We did overshoot the flash crash low, although it didn't turn out to be nearly as catastrophic as I will admit I thought it might be. We are basically above the downtrend line. We've broken it more by time than by price. I really am loath to give the 50 MA analogy again, but look, that really was the resistance. It really should be the support now. We are, however, below this channel up move. It did kind of hold the 20 a little bit. You had a bit of a emotional day here on the 21st, 321. So let's use that range as the key. Anything below 97.02 will be a row short. Anything above 102.10 will be a row long. That's, to me, the best setup for Netflix. And, of course, in between there, we are just hands off. At least me is hands off. The Google, I've talked about this. I don't really like to play around with Google when it's mid-range. It's very choppy. I like to buy the channel low or short the channel high. If you must, 752.05. Above there is bullish. Below there is more iffy. I'm going to keep it that simple. It's really that simple. One I haven't talked about in a while, which is making its way back into the video here, is the Tesla. So Tesla, we can see the 200 MA here is an important moving average for this stock. We got above it, and it got there after a really, 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 really steep and epic move. You got a gap fill, and now a retest back lower. So we are on this trend, although that trend to me isn't really as relevant. We can actually gray it out. It's been violated already, as is this old uptrend line, not as relevant as it once was. So we're back sort of into the mix here. And look where we, Friday was a gap down, and look where the rally stopped, right at the 200-day moving average, right on the downtrend. All right, so what does this mean? This got basically back to the gap fill. We're pulling back. The next key levels in this stock, there are some key levels in like the 20s, but for me, the more important numbers are in the lower 200s, like the 200 to 205-ish area. That to me would be an interesting level, as would the 91-ish area. This low was 95, 195. If we were to throw, just for fun, if we were to throw a Fibonacci on there, 141.05. Why isn't this snapping properly? 141.05. Did it peak right? 239. Yeah, it's a little funny. We'll take out the 38.2. I don't really buy 38.2s on pullbacks, but this to me, look where these 50 and 61.8 Fibonacci's fall, particularly the 50%, right on this basically 191 level. And you have a 50 MA there. I would be interested in maybe buying the dip mid-range here. I think that would work. I put ratios to play for that. If you do have a false breakdown here and this does come up over the 239.88, I would be hard-pressed to think you don't see 265 rather with the quickness. So that would be the way I would play it. Above here, long. Below here, you can play cautiously short for a little bit lower, particularly over Friday's range or below it. Chipotle. This is acting very much in accordance to how we have discussed. The breakdown of 532, we got above there, looked a little bit above there, and then had some news and came lower. Held a 61.8, failed on the back of the 50 MA. 50 MA, again, it's becoming more and more important as volume gets lighter and algorithmic trading picks up on these things. Anyway, this pullback low is important here. This 452.78-ish. Anything below there to me would get a little bit more iffy. If you can retake these 2-day highs and get over the 50 MA, I would think that the stock would go higher. You have a mini kind of head and shoulders in here with a neckline of about 493.11. Anything below there to me remains iffy and vulnerable. Yeah, so that area up into there between the 493.11 and the 500 to me is probably going to be some resistance now, considering that's the backside of this old uptrend. It's the 20 MA and roughly where the real breakdown took place. So longer term, I really don't have that much of an opinion longer term. Shorter term, I can tell you that I think that if there's a move up here, it'll be to here, and if there's a move down, you probably, I don't know if these would hold, considering this swing low is really close to here. You probably could fill up that triangle and try for a double bottom. So that's my view on Chipotle. Anyway, I think we're long enough into this here. We're close to an hour. Holy cow. Anyway, I hope you guys have a good week and happy Easter. And if you want to leave me some comments, I'd appreciate it. If you're not following me on Twitter, please do so. It's at Justin Pulitzer. Please hit the subscribe button below. You'll get notifications when I post new weekend review videos, Periscope rebroadcasts, or special edition videos. I assure you there will be some more of those. They are usually very informative in my view. Anyway, let's have a great rest of our weekend, the last few hours of it, and cheers.